In October 2010, while much of Europe watched headlines about Greece, a quieter shift was taking place in Berlin. Inside Germany's finance ministry, officials were approving guarantees that few voters fully understood. This story is about Germany, the euro area, and the years after the global financial crisis. It explains how debt risk did not disappear, but slowly moved from weaker countries toward the strongest one. It matters because this shift still shapes Europe's banks, pensions, and political tensions today. At the time, Germany was seen as the careful saver of Europe. Its debt was manageable, its exports were booming, and unemployment was falling. Ordinary German families noticed steady jobs and low interest rates on mortgages. What they did not see was how shared rescue programs quietly changed who carried the risk. According to archived records, these guarantees were designed to calm markets, not make headlines. They were approved in late-night votes and technical language. By the end of this story, you will understand how Germany became Europe's silent backstop, and why this happened without most people realizing it. So how did safety slowly turn into responsibility? The real beginning sits earlier than most people remember. It starts in the late 1990s, when Europe prepared for a shared currency. Germany agreed to give up the Deutschmark, a symbol of post-war stability. In return, strict rules were promised around debt and discipline. According to official documents, these rules were meant to protect careful countries. The idea was simple and comforting. No country would be responsible for another country's debts. When the euro launched in 1999, this promise mattered deeply in Germany. Older Germans still remembered inflation wiping out savings in their parents' time. Politicians reassured them that the new system would be even safer. Behind closed doors, banks across Europe began lending as if risk no longer mattered. Interest rates fell sharply for countries that once paid much more. A small business owner in southern Germany later recalled how credit suddenly felt endless everywhere. The early warning signs were visible, but easy to ignore. And this quiet comfort set the stage for what came next. The first real shift appeared after 2008. The global financial crisis did not begin in Europe, but it quickly exposed weaknesses there. By 2009, government debts in several euro area countries were rising fast. Greece reported a deficit far larger than previously disclosed. Bond markets reacted almost immediately. Interest rates for southern countries began to separate from Germany's. For the first time, the promise of equal safety inside the euro was questioned. Inside German institutions, concern reportedly turned to containment rather than blame. In 2010, emergency meetings multiplied in Brussels and Frankfurt. Germany agreed to temporary rescue tools framed as exceptional and limited. The numbers sounded technical, but the commitments were real. Billions in guarantees were approved within weeks. A regional banker in Bavaria later described clients asking why foreign debt was now discussed in local news. Officials insisted this was a firewall, not a transfer. But this moment quietly marked the first movement of risk. At the center of this story sits the euro payment system. It runs quietly through the European Central Bank in Frankfurt. The system is called Target 2. It is how money moves between banks across the euro area each day. When a Greek bank sends funds to a German bank, Target 2 records the balance. In normal times, these balances stay small and fade away. After 2010, they did not fade. They grew and stayed. Germany's central bank, the Bundesbank, accumulated large claims. Other countries built matching obligations. According to insiders, this was treated as plumbing, not politics. One former official described it as numbers that only technicians watched. A factory owner in northern Germany noticed nothing unusual. Payments cleared, wages arrived, and life felt stable. The mechanism worked smoothly. And that smoothness hid the weight it was quietly carrying. The consequence did not arrive with a shock. It unfolded slowly, almost politely. By 2012, internal reports showed Germany holding hundreds of billions in central bank claims. These figures appeared in Bundesbank balance sheets and European Central Bank summaries. They were public, but rarely discussed outside specialist circles. According to archived records, some officials grew uneasy about the scale. Others reportedly argued the risk was theoretical, not real. Inside Germany, daily life continued unchanged. A retired saver checking his bank statement saw stable interest payments. No tax bill arrived with an explanation. No vote was held on these balances. The shift happened through accounting entries, not cash transfers. According to insiders, this made the burden easier to accept and harder to see. The system still looked calm on the surface, but the numbers underneath kept growing. After the immediate crisis faded, the decisions did not stop. They quietly repeated and expanded. New rescue programs replaced old ones. Temporary tools became standing arrangements. The European Stability Mechanism was given a permanent role. Germany approved guarantees again and again through parliamentary votes. Each vote seemed technical and limited in scope. Together they added up. By the mid-2010s, Germany backed the largest share of euro area support funds. The Bundesbank continued to carry rising Target 2 claims. According to official data, these balances moved with every new round of stress. A civil servant in Berlin later recalled how documents grew thicker each year. The language became more complex. Public attention faded as urgency disappeared. What began as emergency support settled into routine policy. The pressure became visible during moments of renewed fear. One clear moment arrived in the summer of 2015. Capital moved rapidly out of southern Europe. Banks shifted funds toward Germany and other perceived safe places. Target 2 balances reacted almost instantly. Germany's claims jumped sharply within months. This movement was recorded by the Bundesbank and the European Central Bank. According to published figures, the increase was measured in the hundreds of billions. Inside institutions, this was seen as a stress signal, not a crisis, but a warning light. An economist present at the time later described screens updating faster than expected. Outside, nothing dramatic happened. Shops stayed open. Salaries were paid on time. The system held. But the strain was no longer invisible. Looking back, the pattern becomes clearer. Germany did not set out to take on Europe's risk. It stepped into it gradually through rules meant to hold the euro together. Each safeguard pushed pressure toward the strongest balance sheet. History shows this pattern repeating in monetary unions. Stronger members become anchors when weaker ones strain. The process feels technical, but the result is political. Risk concentrates where trust is highest. According to insiders, this was understood but rarely spoken aloud. Public language focused on stability and solidarity. Private discussions focused on containment. The question was never about winning or losing. It was about keeping the system intact. And once that path began, turning back became difficult. The effects of this pattern did not end with the crisis years. They still shape Europe today. Germany's central bank continues to hold large cross-border claims. These balances move as confidence rises or falls. During periods of market tension, they grow. During calm periods, they shrink only slightly. This influences debates about inflation, interest rates, and fiscal rules. German savers notice long periods of very low returns. Governments argue over responsibility and fairness. The structure remains in place, unchanged in design. According to recent data, Germany still carries the largest share of internal euro system risk. This is not a forecast. It is a continuation. The past is still present in the numbers. This story leads to a simple conclusion. Germany did not absorb Europe's debt risk through one bold decision. It happened through systems, guarantees, and steady acceptance. Each step felt reasonable at the time. Each step reduced panic and bought calm. Over time, calm carried a cost. History offers similar moments where stability depended on one strong center. The center rarely chose that role openly. It inherited it. Germany's position today reflects that inheritance. Not as a villain or a savior, but as a pillar holding weight placed there by design. The question now is not about blame. It is about understanding. And what understanding might change next time pressure builds.